Right. You lot are always blowing up the comments. Chris, what's the secret sauce? What indicators are you running? And then I see the charts you post.
Yeah?
It's a proper mess, innit? 50 different lines zigzagging everywhere.
Right.
Looks like a toddler got hold of the crayons.
Mate, that's because they're listening to so-called gurus on TikTok
Oh, yeah.
who tell them the MACD, RSI, Bollinger Supertrend combo is the holy grail. It's just noise. Absolute nonsense. Most of those indicators are telling you the exact same thing anyway.
Exactly. So today, we're sorting this mess out. We're going back to basics. Proper CMT level 1 stuff, but with the big short club spin, obviously. We're talking leading versus lagging indicators.
Okay.
And we're going to settle the score. Which one actually makes you money, and which one's just for charty nerds who like drawing lines?
I'm calling it now. It's a trick question. They're both just staring at the past. The real alpha is in the fundamentals. But you CMT chart gazers wouldn't know about that, would you? Busy calculating your Fibonacci levels.
Oh, here we go. Mr. CFA is in the building, ready to read us a 100-page report on a company's Q3 earnings. Mate, by the time you figured out their price-to-earnings ratio,
Yeah.
the coin's already pumped 50% and dumped back to zero. The market waits for no one.
All right. Point taken. But you can't deny the risk of your speedy methods.
We'll get to that, but first, let's start in your comfort zone, Morgan. Let's talk about lagging indicators, the slowpokes, the tortoises of the trading world.
See, immediately disrespectful. They're not slow, they're confirming. It's a little thing called discipline. You might want to try it sometime. A lagging indicator, like a simple moving average, is your rear view mirror.
Right.
It gives you a smoothed out, undeniable picture of the road you've just traveled.
A rear view mirror, you said it yourself. You're driving your portfolio at 100 miles an hour, staring in the rear view mirror. Who does that? You're gonna crash, bro. A 50-day moving average just tells you the average price over the last 50 days. It's old news. It's yesterday's chip paper.
Is it though? Let's be practical. If the price of an asset breaks decisively above its 200-day moving average, it confirms you are in a major long-term uptrend. That simple rule stops you from getting shaken out by one bad day or one scary headline.
Okay.
It's the institutional benchmark for a reason. It separates investing from pure unadulterated gambling.
It's the difference between buying Bitcoin at 25K and buying it at 45K. The most famous lagging signal of all time, the golden cross, that's the 50-day MA crossing above the 200-day MA. By the time that signal prints on your chart, the smart money, the real traders, are already in, gassed up, and probably thinking about where to take profits.
Right.
You're just getting the entry signal. You're turning up to the party when the lights are coming on. You become the exit liquidity.
That is a gross exaggeration and you know it. It filters out the chop. Most retail traders get absolutely rinsed because they overtrade.
Yep.
They buy every little green candle and panic sell every red one. A simple moving average strategy, buy above, sell below, would keep them in the big, profitable trends and save them from themselves. It's a safety net against their own emotions.
Fine. Let's talk about another one then, the MACD. Sounds well fancy, doesn't it? The Moving Average Convergence Divergence. Mr. CFA, do the honors. Break it down for the people, but try not to send them to sleep.
It's just the relationship between two moving averages,
Okay.
visualized as an oscillator to make it easy to read. When the faster line crosses above the slower line, it's a signal that upside momentum is building. It's a trend-following and momentum-confirming tool. It's lagging, yes, but it's brilliant for seeing if a trend is gaining strength or getting exhausted.
Exhausted is the word. By the time your MACD gives you a bullish crossover, your move is already half done. It's like getting a notification from your mate saying the party was absolutely legendary at 9 a.m. the next morning. Thanks, mate. Super helpful.
So what's your alternative? Just close your eyes and click buy? Just ape in and pray?
No, I'd rather be predictive. I'd rather use an indicator that looks forward, a leading indicator. This is where the real P's are made, my friend. This is the sat nav telling you there's traffic up ahead.
Right.
Not the rearview mirror showing you the jam you just sat in for an hour.
The crystal ball, of course. Go on then, Gannav. Tell us about your magic lines that predict the future.
Let's talk about the king of oscillators, the RSI, the Relative Strength Index. This little beauty moves on a scale from 0 to 100. It measures the speed and change of price movements, its internal momentum.
Okay.
The simple interpretation is if it goes above 70, the asset is getting a bit frothy, a bit overbought. It's getting hot. It might be due for a cool down.
And below 30, it's in the gutter, it's oversold, might be due for a bounce. I know the textbook definition, Chris, but let's be real. How many times have you or the people watching seen an asset's RSI go to 80, 90 and just stay there for a month?
Right?
While the price goes on a mad parabolic run. If you'd shorted when it first hit overbought at 70, you'd be wrecked, utterly liquidated. Your account would be a crater.
That's because you're using it like a blunt instrument. That's the rookie mistake. A true chartist, a proper CMT in the making, doesn't just blindly sell at 70. We look for the real secret sauce, dramatic divergence.
Okay, explain divergence.
Bruv, this is the alpha. Pay attention. Divergence is when the price is doing one thing
Okay.
and the indicator is doing the opposite. Picture this. The price of a coin grinds up and makes a new higher high.
Yep.
But on your RSI window, the indicator makes a lower high. That's the market whispering in your ear, oi, this looks strong on the surface, but the engine is sputtering.
Right.
It's the momentum is fading.
That's your high-level warning shot before the price turns.
It's a warning, I'll give you that. It's a crock in the armor, but it's not a guarantee, it's a game of probabilities. For every beautiful divergence that plays out like a symphony, there's 5 that just fizzle out and the trend screams higher. It can be a recipe for getting chopped to pieces if you fight a strong trend. You're essentially trying to step in front of a freight train.
And if you're good, you step on the platform just as the train is slowing to a halt. You get in at the absolute bottom or out at the absolute top while you're still waiting for your 200-day moving average to slowly curl upwards like a confused snail.
Right? I'm already in the trade, up 30%, and I've moved my stop loss to my entry price. I'm in a risk-free trade, mate. Zero stress.
All right, you've made your point. So let's get to the crux of it. If lagging is too slow and gets you in late, and leading is too fast and gives you a load of fake outs, what is the average trader watching this actually meant to do? Don't just leave them hanging.
Now we're talking. This is the synthesis. This is the bit you usually have to pay for. You use them together, you melt. They are a team, a partnership, a dynamic duo. Exactly. Think of your leading indicator, your RSI or your stochastic, as your scout.
Okay.
It goes ahead of the main army. It goes into that oversold territory below 30. That's its job. It waves the flag and gives you a heads up, shouting, oi, get ready, we might be about to find a bottom here.
Right.
Start paying attention. You don't just ape in on the scout signal alone. Seriously, that's how scouts get ambushed.
Right. So the leading indicator is the idea generator. It puts a specific chart on your watch list.
Exactly. The RSI is flashing oversold on the daily chart. So you're watching, you're stalking the trade like a predator. Now what do you wait for?
What?
You wait for a bit of confirmation from your slowpoke, reliable lagging indicator. You wait for the price to actually turn and cross back up above a short-term moving average, like the 10 or 20 period. Or you wait for the MACD to have its bullish cross.
So the leading indicator identifies the potential reversal zone.
Yep.
The lagging indicator confirms the reversal has actually begun and the price is starting to move in your favor.
He's got it. The CFA brain can compute after all. It's a 1-2 punch. The leading indicator tells you where to look.
Right.
The lagging indicator tells you when to pull the trigger. One provides the setup, the other provides the entry signal. It's not simple, but nobody does it.
So all that roasting about me using rear view mirrors